It's really great to be here in the flesh. And if you don't know about YL Ventures, I'm sure you do, but we're a cybersecurity only, seed only, Israel-based only venture capital firm, meaning we invest in Israeli entrepreneurs. We start at seed and then we continue investing through the A rounds, the B rounds, etc. Usually investing our pro rata. I think what we're most well known for is we're headquartered in the US, which is where I live, just outside of San Francisco. And we specialize on helping security entrepreneurs make it in the US market. So we're very focused on go-to-market, meeting customers, distribution partners, follow-on investors, hires. So we're very, very active there. We have about 8 or 9 colleagues, YL Ventures employees in the US. There's about 12 of us here, led by my partner, Ofer Schreiber, over here. So again, super happy to be here in person. We have a very interesting discussion tonight. We're going to keep it quite informal and try to have fun as well. And we'll start by the panelists introducing themselves. We'll start with you, Zohar, and go that way.
Thank you. Hi, everyone. My name is Zohar Alon, founder of Dome9 Security. Sold to Checkpoint 3 years ago. Retired for 6 weeks now, but who's counting?
Hi, everybody. Adi Sharabani. I founded Skycure, mobile security. I've also, it was 2017 when I sold it. And last year, about a year ago, I left and lived in a caravan, in an RV, and just came back to Israel. So very happy to be here.
Made Aliyah. Welcome.
Hi, everyone. I'm Gil. I'm the Chief Product Officer and co-founder of Orca Security.
Very good, very good. So all three, founders of great Israeli security companies. Some of them more than one. Definitely involved in the whole Israeli cybersecurity ecosystem. All three make angel investments or advise other companies. And so, we have quite a broad set of knowledge here. So we're here going to talk about growth, about later stage growth as well. There seems to have been a shift in the industry where, if you look back 10 years ago, there were a lot of quick flips, quick exits. I would say limited ambition. For lack of better term. But now it seems like, well, first of all, Israel is number one in the world in terms of unicorns per capita, more than the US. The absolute number of unicorns is staggering. And it seems like so many entrepreneurs have big ambitions, trying to create, multi-billion-dollar companies, at least in terms of value. Are not looking to be acquired quickly. And I'd love to understand from you why you think that is, and also, do you think it's here for good? Do you think it's gonna stay like this, or is it just a function of the times? Anybody want to start?
Let the unicorn start, Gil.
At least in my opinion, it's a combination of multiple factors. One is, of course, I think that the industry matured. We understand and know that we can achieve more and grow more. I think another important factor is, of course, access to funds. And something that did change in the last few years is that there is more access to investments, which allow you to grow a bigger company and a more sustainable company, rather than a few years back where you had to struggle, I think, more in order to get investments. And I would say that the third factor is also a huge shift in technology. The shift to the cloud, the shift to different architecture, different approaches for security where the traditional methods fail. So it means that there is room for new players. There is room for innovation, much more than there was before. And with the digital transformation, I think, of most companies, also what companies have in stakes in terms of digital assets is much greater. So they are, in my opinion, willing to invest more in these kinds of security and protections than it was even 4 and 5 years ago.
I think that, when I tried to raise my A round and even my B round, Insight were not around. YL Ventures told me no for more than once and many others. Today, when you can find a company in the A round that is raising 50 million, you can pretty much guarantee that they will not sell for 200. And that puts them in a situation where they kind of have to, or they have enough runway to get to a point where even for Microsoft it would be a serious decision or not a common decision to snatch them like Adi and like Adi's company and my company was gobbled up by much larger enterprises. You can still see 500 million exits, but they're more scarce. And if you fund the company well enough in the A/B round, you pretty much guarantee that they'll have to, follow Gil's footsteps. Maybe you can explain the Snyk example. Like, it was clear that you can as an investor lead the company that way.
Yeah, I think that entrepreneurs always wanted to have something big, right? It's not about, now I want something big. Before that, I didn't want something big, right? But the set of opportunities and the set of tension factors, like what Zohar just mentioned, of there is friction with getting a lot of capital associated with quick exit, right? So all of these factors just leads to more occurrences of unicorns, much more than we've seen before. So I think it summarizes what both of them said.
And also multiples. When I sold, it was, we were well over $10 million in ARR. And, today this is it's a big unicorn, not even a small one. So you can get, so when multiples change, kind of everything happened. No smaller exits. And then entrepreneurs see themselves, you can fund yourself nicely in one of the secondary rounds throughout. We were also almost 8 years in the making of the company. How old is Orca? Not even 3.
3 years almost.
3 years old. That's a huge difference.
This leads to another point, secondary rounds. It's much more common and actually pushed by some investors. And that gives the founders of the company more, room to allow themselves to take additional risks on growing the company furthermore.
Absolutely. Can we talk about Snyk, do you think? Yeah.
Without sharing details?
Without sharing details that we cannot share. So Adi, by the way, Adi, this is Adi's first event since he came back to Israel.
True.
You came when, in September or August?
That was August. Yeah, late July, beginning of August.
Yeah, and we're honored that you chose this event as your first event. Tell us a little bit about Snyk. You were, I think, the first money in. Tell us about that experience and their growth and where they are now.
Yeah, so I invested early on, not the first money in, but very early on. I think this is an extreme example. So sometimes, founders try to compare to stuff, and there's sometimes areas where all the stars are getting aligned, like these guys, which is like really, really extreme. So obviously we need to learn from that. We want to capture whatever we can, but we need to also realize that the baseline is not that, right? I think what Snyk did well is that they understood the real problem that customer had, and they understood that all the companies that played in this space were trying to take a very specific go-to-market motion and change that go-to-market motion. And they moved into developer-first agenda, like they're selling security through the developers, which was something many have talked about before, but not really fully did. And I think that a lot of times, especially in Israeli technology, in Israeli startups, people are thinking from the technology and then try to apply that to the go-to-market strategy. And I think one of the unique things about Snyk is that they did the opposite. They really started with the go-to-market and then how the technology could allow that, enable that.
Great. Let's go back to these really large rounds, really large A rounds, really large B rounds. What effect do you think that size has on a small startup? What are the good outcomes from that, and what's bad about that?
So the fun part is that you can start and run, right? And that's amazing. That's awesome. And I think in general, there's a lot of great benefits to that, which we don't need to really explain to the people here. But the challenges associated is one, that if you don't really know where you need to head, you're wasting money and time and efforts, not in the right direction. So sometimes when you have a lot of capital, you can spread your investment into too many areas and lose the focus that a company needs in its early stages. So this is something that I sometimes see in today's market, where the companies are not diligent enough in deciding what they want to do and do too many things at the same time. And the biggest problem is that the brains, especially of the founders, and the focus is set. You don't have more investment of that, right? The second element is that it really changes what you're looking to do with the company. In the past, you've seen a lot of great, very quick acquires, 20 million, 30 million, and that was awesome. These type of things are not possible with too big of investments. And I think this is fine because I like the fact that people are focused on really building cool and amazing businesses. And I do see that because the entire market became more, with more capital, we're seeing that the acquirers are willing to pay more. So it shifts into that area as well.
So I think I pretty much agree with Adi in the terms that on one hand, you can dream big. You can, if you have a good vision of where you want to take the company, and that vision is aligned with what you can and what you should do, then you have the opportunity to do that. I think that on the other end, you have less room for mistakes because you need to move much faster than you were before. And any kind of friction could be a significant one. Another, I think, challenge that it brings is to understand where you have just a physical boundary of what you can and can't do. Like in many times, we are thinking of doing something, and then we actually, in your head, you suddenly think, wait, maybe it's too fast, and then you need to decide whether it's too fast or too slow, and move on that really, really quickly. And you have that some margins of errors when it comes to exploring new stuff. And so I think it brings a lot of stress to the team on one hand, because you need to move faster, but on the other hand, you have the opportunity to dream big. And also your partners, your employees usually love it because they are part of a journey now. They're part of something very, very significant, and they know that, and so it allows them to dream big as well.
Other than raising capital, a CEO's job is to make sure his team can deploy the capital. Raising X but spending for a quarter of that, or planning to spend a third of that, is an issue. So, and I think I see the flip side of that is that when you start spending too much money, and your tolerance for error drops dramatically because mistakes are very costly. I saw it with several of my competitors early on that we never had market until 2015, 16, not even, maybe 15. Some of my competitors raised a lot of money in 2012, 2013, and then they deployed it. They deployed big. There was a huge round for the time. You remember Cloud Passage and some others, ThreatStack. And so you get used to deploying a lot of money. There's no return in that motion. It takes you about 18 months to figure out that there is no return. I didn't have that problem because I didn't raise that much money to even explore those areas. And then going or falling down from that understanding, scaling down a team, and maybe even getting revenue that are not sustainable because you never renewed them. You were able to sell a $2 million 2-year deal, but the customer never deployed it. You didn't really tell your investors that this is revenue that you should write off from the get-go. And then you say, let's fake it until we make it. But what happens if you don't, because the product wasn't there, because the market wasn't there, because you ran it a different direction? This can cost you your company. And that's a potential risk of flying too high or too fast.
Let's talk about the different stages of a company in terms of the different investors for each stage, right? So obviously there's the seed stage, and then there's the Series A and B, and then there's the growth stage, and then there's the beyond growth stage, there's a pre-IPO stage, et cetera. Can you guys maybe share your perspectives on what do you think entrepreneurs should look for in each one of those stages? And if you want to provide examples, because you've all had, investors at different stages, what was the most value that they provided, or what is it, or what should they provide at each stage?
I think that, especially if this is your first rodeo show, you must bring and think who are your partners. So the seed investor is critical in terms of selecting someone who can help you, guide you, and complete you in areas that you don't have enough experience in. Whether it's go-to-market, whether it's marketing, whether it's just starting a company, because it is something that requires some knowledge. Obviously, a lot of these knowledge can be bought, but it's great to have someone who's willing to fight with you in the fights and to help you in the trenches, so to speak, because there are trenches, especially at early stages, where you're not certain about product market fit. There is risks. There is challenges in establishing the first POCs, getting to the first POCs. And so I think the seed stage is critical in terms of selecting the right partner for establishing a company and trying to figure out a product market fit. I must admit that it's very difficult for me, to differentiate A and B because they happen so quickly. But basically, we looked for partners that can help us with the growth or the initial growth. We had only a bunch of customers, and we looked for partners that have taken companies from A to IPO and help us, establish that product market fit better and grow within our market. And in our last round, what we are looking for is mostly someone who can basically support a very large and substantial company. So obviously, we are not that large yet, but we plan to be. And we had the opportunity to raise capital and bring in another investors. And so it's playing in your head the game of what I need if I'm that multi-billion dollar company, and who do I need as a partner while I'm at that size. And that's what we try to figure out, and who can basically allow you to dramatically expand globally and also deploy significantly more capital if needed as the company continues to grow.
I always look at it as like I look at my executive team, right? You want to build them as a puzzle, and you want to understand what are the tools that you currently need. And then when you talk to investors, you want to ask yourself whether this is a person I would go and acquire some of those tools from. So if the current gap that you have in your company is your knowledge on how to build an operation, that's one thing. If the current gap is how do I scale a go-to-market motion with partners and so on, that's another thing. If my need is to go into the US today or to Europe or anything else, that's another thing. And what I always try to do is not just to think about theoretically what are the right partners for that, but also look at my board as a puzzle. We have identified there was a space called MDM, which was adjacent to our space. And we targeted those investors that invested early on in those spaces. So there were three biggest companies that played in that space. And we managed to take one investor that was the founder of one of those companies, one investor that invested early on in the second company, and SVP sales at VMware that ran AirWatch, who was the third company that was acquired over there, who is, by the way, the CEO of Snyk, but that's a different story. So I think always try to look at that from the puzzle perspective and try to understand what is missing in those. Sometimes it's, by the way, it's a cultural thing in the board. Like I need a board member that will be more communicative or help lower down the voice, or the opposite, make the board a bit more valuable and more promote more discussion in the board and so on.
Israeli.
Israel, yeah.
I'll start from my C round was SoftBank. So, and this was at a stage where I was already actually neighbors with Adi. Our youngest learned together in preschool in Palo Alto. I met SoftBank there. They led our C round. For the first time in my life, or in Dome9's history, we had an abundance of money to execute, and now, okay, how do we scale that? And SoftBank came with a lot of, this was before the Vision Fund, just when this was the guys that invested in Cyberism and in Zimperium here. And we saw a lot of strategic value from them, even though we wanted the money. We didn't really care, but don't tell anyone that we would have taken their money regardless of whether they had strategic value or not. But it came with a distribution agreement in Japan. It came with, we have a Japanese version of Dome9 till this day because of that cooperation. And it was, for me, important to see that I can augment I had two ex-Israeli Americans in my board. The three of us led the company. They helped me lead the company for 7 years, give or take. And then the SoftBank guy joined, and we were talking business with him. He forced us to speak Hebrew to speak English in board meetings. It was fun to do them in Hebrew before that. And for example, the acquisition, which was for us almost a year-long process, I spent with two of the two ex-Israeli board members a lot of energy, a lot of time, a lot of crises, some real, some not. And as a CEO, this is where you rely, where I spend most of my time at that point in getting the advice, getting the thinking together, and letting them pay for their hard-earned equity.
Great. So these primary rounds, and you mentioned secondary as well, but these primary rounds in successful companies are generally, kind of a tight puzzle to figure out, because the new investor wants to have ownership, the current investors want to maintain ownership, and in successful companies there'll be, sometimes even a long list of other investors that are trying to get into the deal, can't get into the deal. So the primary rounds have a certain capacity limitations to them. And some of these companies grow, become very successful, and the CEO, might actually want to bring in more investors than he can or she can in the actual primary round, right? And so we've been seeing a lot of secondary happen as well. One purpose of secondary is to provide liquidity to founders and to early employees, sometimes not even just early employees. And it's also been, when providing liquidity to founders, it's been a way to take some stress off and make sure that founders kind of are aligned with VCs.
They don't sell too early, yeah.
Exactly. They don't sell too early. They go the whole way. But our secondary is also a tool to perhaps bring in investors that otherwise wouldn't fit into the primary, and connected to that, if early investors decide to sell at that point and provide some capacity to those new investors that the CEO and others want to bring in, how do you view that? Is that and that's a relatively new innovation. What do you guys think about that?
I remember the point where stopped bothering or stopped worrying about a new investor bothering me, and saw how my executive team and myself leveraged them. And this was a point where you realize that they don't just say they start working for you, they work for you. And if some of them, as a CEO, gives you, wants updates in a frequency that's you're not happy with, there comes a point in the CEO life when he can say, okay, you want to do it every 2 weeks, I want to do it every 2 months, we'll do it my way. But to help me, that I want you to do, and I'll actually send my VP of Biz Dev to leverage you. So the more investors, actually, the merrier, in that sense of you have that equity. It's already there with the investor. If he can sell it to another investor, then you have another partner or another team or maybe a whole strategic organization. If it's a CVC, you have a whole corporate behind that extra equity that without that secondary round, you probably would not have been able to get into your cap table and to get that leverage. And the moment you as a CEO can deal with the pressure coming from an additional investor, that's the time to actually take more on.
I think we need to differentiate between secondary rounds where it goes to the employees of the company and secondary rounds that goes to a new partner that you bring in. And I think that if we look at the investors as a partner, as an advisor, you need to change your advisors every once in a while, right? So assuming that it's aligned with what you need now in the piece of the puzzle that is missing for you now, I think that could be a great thing for the business.
Yes, so I think I completely agree with my colleagues here. I think that, as said, in different times on different scale, you need different partners. And even though it could be, a huge click even from early on, and it's great to continue these relationships. Some of these players in the later rounds will not join the company or will not invest in the company for a small portion. Yeah. And these strategic investors can really make a difference in these scales, and especially when you're trying to build something significant. And so to that respect, I think that if an early investor is willing to make room for that, it could be for the benefit of the company. It could impact significantly without dilution or without significant dilution to the company.
That's great, because at YL Ventures, we're always trying to think of ways to help our portfolio companies. And obviously, in the very, very early stages, we've kind of mastered that with BD introductions, marketing help, financing help, getting them to the A round, product market fit and all that. When you get to sort of a Series C stage, then it's understandable that, when a company is, crossing the 10 million ARR, et cetera, one more customer introduction from YL Ventures is not really going to move the needle too much. And so we've realized that. And when, super helpful growth investors, Wall Street type investors that can invest at the IPO and after the IPO, can really help a kind of a growth stage company. We've realized that we could create potentially a win-win-win situation by making some room and potentially selling some of our shares to later stage investors that can potentially provide complementary value at that late stage. And so, that's something that we probably plan on keep on doing and trying to find win-win-win situations like that. So let's talk about the cloud security sector a little bit. So Gil, and also Zohar, obviously. So, Gil is kind of more of a newcomer from the last 3 years. Zohar, you started, I guess, more than a decade ago, and that was already cloud security. And it just doesn't seem to stop. Cloud security just is such a hot topic. I think the pandemic really kind of helped fuel digital transformation and the move to the cloud. So I'd love to hear from you guys about that sector, where it's going. Is there still room for innovation if entrepreneurs are looking to start in that area? What do you guys think?
So I just came back from the AWS show in Vegas 2 weeks ago. And, it felt like the first one, like the energy that you know, it wasn't when we started Dome9, AWS was, people didn't know how to spell it. It was you know, known by very few, and looking at it now, the energy, they limited to 20,000 people, and it was sold out quickly, and it's not a vendor-to-vendor show. It's really an expensive show that people come to learn. And you know, I look at those, you know, younger kids, and I envy them because of the areas of innovation that are never stopping. Even in our you know, less sexy security segment, where you know, there's data security, there's the API security stuff. You look at what AWS themselves built with the Guard Duty, with Security Hub, with all those services, and how we can augment them, how we can add value. And you know, I look at the Netflix open source projects. You know, these guys are, I call them there's Netflix, and there's the other 99.99% of all the rest. And you see how these guys deal, how they understand cloud. And usually if you look at what they do, you can really get ideas on how to build innovative things in an area that is, we all agree, still there's a lot more room to do stuff at. I'm sure Gil sees it when he sees his customers.
I think there's no more room in the cloud. We are completely full. Thank you. So I think that a more honest answer is that the cloud is an amorphic term. I think it's a description of architecture and technology. And so obviously there's still a lot of room for innovation because this architecture and this platform continues to evolve. And it's still young, and I think that there are still a lot of concepts that are not utilized. There's a lot of services that are not utilized. So it's simply because we don't have better terms. Every company that announces today around says, I'm cloud security, but they're doing something in cloud security, whether it's detection of data or detection or identity and access management. Usually, they are doing something in that area because it's so significant and large. But same as there was in other areas, like network security is actually also firewalls, but it's also in some ways vulnerability management in some cases, and also identity and access. And so it's all based on the fact that there is a network and you can do stuff around the network. So I think that there's a lot of room of innovation. And if you have any idea, you can come talk to me.
I think that it's amazing to see that the CISOs are still somehow lost. So they have their strategy, they have a thesis, they execute on a plan that they build if they did their job properly, which is not always the case. But they're still lost. They don't know how their world is going to look like next year, and hence how they are going to secure that world. And I think that brings a lot of opportunities, but also some risks, because in the process of interviewing CISOs, in the process of working with your design partners, you can really get lost today with the niche problem of one specific customer rather than building a solution that will be applied to vast majority of the market. So this is something that I think people need to remember when they go and work with their design partners. Great.
And I have one last question on my own, and then I'd love to open it up to some questions from the audience. I'm sure people have some questions for you. But on back to the topic of growth and scale up, and building larger and larger companies, can you guys each think of maybe one challenge that you had in scaling? It could be a mistake, but it could also just be a challenge that you either that you overcame. You're faced with with a growth challenge. What was the story of that? And I'm putting you a little bit on the spot, but
look, I think for a CEO in the growth stage, hiring and hiring and hiring, and you're involved in the hiring process, not just of your executive team, but also in in other lower levels in the organization. You want to see the fit with the DNA. You want to see what's happening there. You're still not detached. And you need to love it. I hated it. You need to learn to love it and to embrace the fact that, 3 hours a day you will spend interviewing people for relevant jobs, for jobs that you are thinking of filling. This is your scale up kind of objective. And when you feel that it's not coming to you naturally, you need to face the fact that I face the fact that I don't like it, so I actually kind of learn to love it. Like, do it, take it the other way. Otherwise, you'll avoid it. It will be like, like doing homework, and nobody likes that. The other element with kind of managing, looking at how can you, like looking at your new investors, and managing those relationships all the time, even when you're not raising. Today there's probably a lot more inbound, but this is, talking to your potential acquirers, your potential acquisition targets. We see Israeli startups acquiring other Israeli startups. I'm sure this trend is going to happen, and you can be in either direction of that equation or in either side of that equation. You need to kind of establish those relationships and maintain them throughout acquiree, and investors, because those it's probability game. You talk to enough people, you find a match. Somebody has interest that you're not even necessarily aware of, and then there's a match to do an exceptional deal. And you just need to play in the game. You be in the game, and good things can happen.
I think it's all ends up with the personnel. When we're talking about growth, we're not talking about any technical aspect. We're talking about the team. And it starts with the founders as well, and they need to grow into that stage. And I remember, like, in the Skycure days, we were selling, like a few millions a month. And then in Symantec, once I took my last role, it was a few millions a day. And the operation around that is a completely different operation. It's not even the same line of thinking. And I think the biggest challenge is to understand that and understand how you need to grow into that, but also how your team needs to grow into that. And what to do with a leader in your team that has not grown to that level that you need them to be. And identify that and make changes as needed. And this is sometimes hard because these are people that you grow up with, and sometimes they are not just getting into that growth stage of the company in their mindset, in their abilities, in the way they operate. And identify that quickly and acting on that is key, I think, to the success.
My best advice around that is to play the imagine game. So let's say today you are at 50 customers, and in 2 months you're going to be in 150 customers. What will that mean for your operations? What you need to do? What will you need to support it in terms of R&D, in terms of support, in terms of sales? And you need to continue that game throughout. So what I need next year? I have 1,000 customers. What I need to support that? And usually what you'll find out is that you'll reach obvious obstacles that will simply kill you if you will get to that stage if you're not prepared. And the cost could be significant. It could be similar to what Zohar mentioned before, that if you scale, for example, the sales team too fast, you might pay for it by the fact that they are very costly. You will get bad rap in the market in terms of getting the good sales guys, because they will say that they cannot get money from working in that company. And on the other hand, let's say you are managing to execute on the sales part, and the product fails, then you also get bad rep in the market in terms of the fact that the product does not work, and it will also harm you in the future. So my best advice is all the time, be the one that thinks ahead and tries to imagine what will happen if we succeed, what will happen if we manage to get to that point, and what I need to do to promise and to make sure that I can get that.
Great. Very, very good answers, guys. Thank you. So any questions from the audience?
Okay, thanks. First of all, thank you all for the talk. So a question about one of the things that
Introduce
Dia said.
yourself.
Oh, I'm Dean
From?
from 8200.
Okay.
Anyhow, so one of the things you talked about the CISOs being lost today. So, well, why does that happen, and what do you think that they're trying to do to overcome that?
I think many of the CISOs still work in the old paradigm of think about it as the difference between waterfall and agile in a sense. They try to have a plan. And they need to handle serious stuff, right? And it's on their shoulder. They are at risk of being fired every single day. And when you're trying to face something that is constantly changing, not just the landscape of the attackers, but also the landscape of your internal organization, and you don't even know what is the next tool that the developer is going to bring into your product or whatever, it's very hard for them to operate in that environment. And all the methodologies, the way they worked so far and so on was waterfall. It wasn't agile. And that puts them at the challenge. In the past, the CEO or the CIO that the CISO would report to would try to measure how many times they changed their plans. And that was something that is negative. Like, okay, you came up with a plan, and then in the past year, we changed it like 4 times. Today, CISOs needs to be measured on how many times they change their controls, not vice versa. And that changes the entire discussion, and many of them still don't know how to cope with the ever-changing nature of, again, the attackers and their internal organization, as well as the tools, by the way, right? Everything that is being invented in this room is something that CISOs didn't know about or didn't even think about a couple of years ago, right? So,
but I see it a bit differently. I think that I wouldn't say that CISOs are lost. They are in many cases today, they are very much knowledgeable and actually familiar with the challenges that they have. The thing is that the entire paradigm of, of having a perimeter and then protecting your perimeter changed so dramatically so that now you suddenly are bombarded with huge amounts of services. Each of them has a different configuration and different option of being exposed. And I can't tell you how many times the CISO comes with a tool like Orca, says, okay, this is externally exposed, and the DevOps says, no, this is not externally exposed. But it is, because it requires like 4 lines of code to actually understand all of the intricacies of whether it's internet-facing, access control list, networking. And so I think it also demonstrates that that there was a change simply in the technology. And I would say that in terms of communication and the way that security teams work today, they have to work in a very similar way to DevOps, in the way that they have to deploy security as a code in a way, and they have to control security differently, and they have to work with the organization, with the DevOps, with the engineering, in order to actually manage it. And I actually do see companies that manage to do that.
yeah, but I think that the 10% is the ones that are, I would really argue that 90% of the CISOs are not really knowledgeable, and their problem is that they don't have the tools and budgets to address to learn more about their threats. Like if you think about the old world, they were buying software. They would have a budget each year, and each year they would decide where to spend that budget on. Today, because all of us have been smart to introduce ARR models, they commit to a certain expense, but not this year, but also the following years. So the following year, when they come and look at their budget, maybe it's increased a bit, but most of it is already occupied. So they can't really initiate new projects that they can really learn from and experience and so on. And I think that is tough.
Definitely.
Great. Any other questions?
Ido from Cyrus. What are some of the trends you guys see for 2022? in cybersecurity?
I think
I'll let
that,
Adi take that.
and I've been living in an RV for the past year, so I don't know what that says, but never mind. I'm kidding. I think that
RV Wi-Fi hacking.
yeah, there were some challenges. Never mind. I think that CISOs, when you come and talk to them, a lot of times, again, the majority of them, not the few percent of the early adopters that love tech, that love speaking with startups and want to learn and have the budget and all of that, they yawn before you come into the room. And they are looking for someone who really understand their true pains, not trying to sell to them. There is a huge, like today more than ever, there is a huge antagonism to people who are too salesy. And I think that their biggest pains is their lack of ability to really manage everything that they want to manage. And that means that they, generally speaking, don't want to buy new tools that will require new people to manage new type of operation, but rather make their current operation, the current threats they're facing, the current things that they're working on, better, faster, and easier to manage. So if you think about whatever you're building, don't just try to think about what you're bringing better or like what more insights or what more protection you will give to them, but how you will make their operation better.
I think the reason I kind of paused when you asked the question was that, you know, we invest in a lot of the companies that are still in stealth, so we essentially know what's going to come out in 2022, and now, so reality, it's just confidential information in some aspects of it, even though today all the funds and all the investors see most of the deals most of the time. You know, at reInvent, they talked a lot about automation, and then Tor came barging with their B round yesterday or day before yesterday. It's a busy week, huh? And so that's for automation. I'm involved in some kind of like trying to do many things around new looking at infrastructure as code and maybe seeing some innovation in cloud security, data management, maybe privacy. I think privacy isn't solved yet. I don't think you guys like privacy because, you know, the applicable side of privacy, not the, you know, what is it for me as an individual that lives inside a SaaS application? What does it mean? How can I erase myself? How can my identity be protected? How I don't need to, maybe things that will help streamline the people that are building the SaaS application to, you know, incorporate privacy controls quicker. We'll see.
I take the bet of Adi. I think that automation and orchestration will be the hot topic for most companies in the next year. That's at least my bet, and that's, in my opinion, one of their biggest challenge. Some of it will be solved by consolidation, but the fact is that it's extremely hard to grow the security team. It's increasingly becoming harder to fulfill these positions with talented individuals. And I think on top of it, some of it don't want to grow, don't think that they should. They want to simply do it better. And so if I wouldn't necessarily say that you need to start a company like that now, but I would say that from the market standpoint, my bet is that automation will be the next topic next year.
Question over here. We have a mic, maybe?
So we've talked about network security. We've talked about DevOps. My question is, who do you think will own, and we've talked about security. So my question is, who do you think will own security? Who will be responsible? Because today there is a concept of like shared responsibility, and at least with our customers. Oh, by the way, I'm Roy from Tufin. So we see, you know, there's like DevOps, there's DevSecOps, there's network security. We see cloud teams that are more like siloed, and it's not really clear who will own that. Like we see different use cases are involving different persona or different people in the company. Some are DevOps only, and some are also network security. So who do you think will own that? If it'll be one persona, or will it continue to be like a shared thing across different security teams in the company?
For me, it's easy to see that the CISO team will deal with, for example, in like Orca or Dome9's case, we sell to the CISO. It's easier to sell to the CISO. CISOs are rich, they spend, they know how to spend once you get in there. But look at companies like Sysdig or Aqua, they sell less to the CISO. And you can argue that we can do some container security, or they can do some posture, for example. But still, there is a market to attack both personas and to generate. Sometimes they buy, they'll buy Aqua for the container or Twistlock for the container, and they'll buy something else for their posture or for their infrastructure as code, or maybe the other one will own the infrastructure and code, but the CISO team will still do I'm the last line of defense. Because the developer will never be the last line of defense unless he works at Netflix, and then maybe it's very close to the last line. But in a Fortune 1000 organization, the CISO team makes sure that everything stays up. It's not anybody else's responsibility at the end of the day. That's why we can maybe sell, it just grows the market if you can find great DevOps team to sell them some DevSecOps tools.
I think shift left will continue. And I think that there are different types of security in one's organization. And if you're thinking about product security specifically, that, in my perspective, will definitely be the ownership of product. There will be like people under product that will work closely with the marketing team, even to handle events. The company at the global scan needs a CISO, and that function will always exist, and they will always have the resources, and whatever they can to push left, they will. But that doesn't exclude or remove that, piece of the puzzle.
In my opinion, we always have the security team in a company, and I think we always should, because at the end of the day, there is, I would say, friction, internal friction, which is healthy, to make sure that the company is aligned and the security measures are being taken. And at the end of the day, the product and R&D team's main focus usually is to deliver product and to deliver to the business. And even though there are ways to make sure that while they do it more securely, and obviously it's not their intention that anything will be broken or lost, but you need someone who's specifically thinking and has his top mind around making sure that the company's assets are secure. And
we can learn from application security. Application security was a very hard sell for the application teams, or the equivalent of DevOps today. And the CISO could help, but you still need to sell to the R&D owner of that specific R&D organization to deploy, whether it's checkmarks or Veracode or those type of solutions. And you still own, the security team would still either sponsor some of those solutions, but they'll still deploy a WAF, they'll still deploy an API gateway security, and their network security was looking at application security failures. Like you never rely on that developer to be your line of defense. Not taking anything from the stuff that Snyk and Aqua and others can do in that area, and it's an amazing area, and good luck or they don't need much luck to convince you that the developer can have some responsibility. But at the end of the day, I'm the CISO's organization, definitely today, like CISO's organization today are stronger than they were 3 years ago, and I'm sure Mr. Yoav will agree. They are more intelligent, they are more dependent on in this digital transformation, they are a critical part. Doesn't mean anything that the development budgets are still growing and they can still do some things over there.
By the way, I agree with everything that Zohar says. Any last questions from anyone over there? Do we have a?
Thank you, by the way.
Hi, I'm Alec from Checkmarks, and my question is, when discussing cybersecurity, there are dozens of topics such as application security or endpoint security or network security, and within those topics, there are even more products, like thousands of products. So when you came to the point you decided to start your company, how do you build a product that differs you from the competitors?
So obviously it depends on the market that you're in, but you need to first recognize the proper problem. And to that respect, you need to think of or recognize a significant pain point that is significant enough to make the security teams shift from what they are using today. And so there isn't one answer, but the generic answer is, of course, that you need a very, very significant pain point because it's easier to continue doing what you've done so far.
Are you talking about a market that is already established and you want to disrupt that market or creating a new market? And like, it's very different if you want to build a competitive play against new players in the field than when you go to a market that has a budget and you want to disrupt that and be the best among the other products that already exist.
So I probably was thinking about an existing market, because when you are trying to build a new market, you have to convince the people that your product is actually relevant. But when trying to enter an existing market, the people already know that there is a problem there. So how do you make yourself differ from existing vendors that have their own big names already?
Yeah, so I always look at it in three aspects: sell, retain, and grow. Okay, and these are the three main things that you need to think about when you're trying to capture such a market. So first of all, why would you sell so much? Okay, and when we're thinking about that, a lot of times, as I mentioned before, the Israeli technology companies thinking about the technology, like what is the technical edge that I can bring, which is extremely important, but without the go-to-market motion that will support it, that's simply not enough, especially if there are already big players that are playing and has a sales motion in play. So you have to find a go-to-market strategy that will be clearly differentiated from the others in the market. Why would they even come and talk to you when there are so many other players? What is so different about it? So that's on sale. Then when you're talking about retain the customers, that's very much around the product, but also around the customer success and aspects of that. That is, in my perspective, a bit more like a classic discussion. There is not a lot of, I don't want to dismiss, there is a lot of great innovation in customer success, which is a topic that personally I love. But the line of thinking, at least for me, is very classic in a sense, right? We want to make sure that we reach out to the customer. We're not just handling customer support cases, but rather thinking about the customer success and how can we lead them in that journey of taking and utilizing our product to maximize the value for them. And then we're thinking about grow. And grow is part of the sales motion in my perspective. A lot of times you want to think about how can you, like you need to decide whether you want to go in parallel with other products and then grow from there and then replace, or you're coming with a sales motion that replaces automatically. All of those technical details are, a big part of that sauce that will make or break that success. And in my perspective, it's very hard to have a more thorough discussion without details. I've been in the application security space for many years, so I will have to take that afterwards.
No, I have a tip for that. Look at it happened in our market. There were, when Palo Alto started acquiring my competitors, they acquired two, kind of back to back. And then we got acquired, and then Trend and Rapid7 made quick acquisitions. And then Orca was ready to go into our market, but a lot of the things that helped them was, we were not young companies. Redlock were 5 years old when they got acquired. That's not very, very young. And all got corporatized in about the same period of 12 months. Intuit were our customers, and I remember the call with the guy there. He said, look, we're not going to renew. Just after I told him about the acquisition, he said, that's why, like, you like our product, you just deployed it like 4 months ago. We like to work with startups. We don't like those guys that get corporatized and get acquired because they change. You know, I knew I had a direct relationship with you. Under an acquirer, it's not going to stay the same. So when you look at things that are happening, you know, a lot of the V1s, a lot of them are like we were V1 or 0.9 at best of our market. If consolidation happens, and for good reasons, and the consolidations don't kill the companies, we actually grew our market, you can come as a young, energetic, well-funded startup. You don't even need to disrupt. You just execute better, and you come fresh. We spent 3 years just figuring out, you know, trying those little pivots. You don't need to do that. You know a lot of things. Maybe you need like a Kunstpatent, like something to differentiate you to get the foot in the door. But then you can, a lot of repeat entrepreneurs actually, a lot of second timers have the chance to do that. You know, they have a belief about the market. They already know how to grow. They're not afraid. If you give me a market that I know I can sell into and a good product team, maybe even what, you know, Sentinel and Cybereason did was a V2 to a market that kind of was ready to be disrupted. And maybe in the AppSec security, there's also some space for that kind of V2 next-gen motion.
Great responses. So we're just about out of time. Please join me in thanking Gil, Adi, and Zohar. Very, very interesting. Thank you. And